What's the biggest fear people have about retirement? It's not death, it's running out of money. It's a terrifying thought, but what if there was a way to mathematically almost guarantee that it never happens? Well, there is, and it's called the 4% rule. Back in 1998, 3 professors at Trinity University published a groundbreaking paper. We now call it the Trinity Study, and it's the foundation of modern retirement planning. They asked a really simple but powerful question. What percentage of your savings can you withdraw every year, adjust for inflation, and be 95% certain that you won't run out of money after 30 years? To find the answer, they stress-tested their model against every major market cycle in history. We're talking the Great Depression, the insane stagflation of the 1970s, the big crashes of the 80s, all of it. After running all the numbers, they landed on a single magical figure, a safe withdrawal rate of 4%. This simple rule can change the way you think about your financial future. So, how does this actually work in real life? Let's break it down, because there's a crucial detail most people get wrong. Imagine you've worked hard, you've saved diligently, and you retire with a nice, round $1 million. In your first year of retirement, you apply the rule and withdraw exactly 4%. That's $40,000. This is your income for the year. Easy enough, right? Now here comes year 2, and this is the important part. What do? You might think you recalculate 4% of your new portfolio balance, but that's incorrect. It doesn't matter if the market went up 20% or crashed 20%. You completely ignore your portfolio's total value. Instead, you look at just one thing, the inflation rate from the previous year. Let's say inflation was 3%. You give yourself a 3% raise. So you take last year's $40,000, add 3%, and that gives you your new withdrawal amount, $41,200. You then repeat this exact process every single year. You take the previous year's withdrawal amount and just adjust it for inflation. You might be thinking, wait, what if the market tanks? Won't I run out of money? The Trinity Study showed that in 95% of all historical scenarios, this strategy works. Not only did the portfolio last for 30 years, but in most cases, it actually grew significantly. Why? Because over the long term, the growth of your investments typically outpaces your inflation-adjusted withdrawals. You're only taking out a small, disciplined slice, letting the rest of your money continue to work for you and grow. But, and this is a big but, we need to add a modern perspective. The Trinity Study was based on a traditional 30-year retirement. What if you're part of the FIRE movement, financial independence, retire early, and you plan to retire at 40 or even 35? Your money needs to last a lot longer, maybe 50 or 60 years. In that situation, the original 4% rule might be a little too aggressive. The longer your retirement, the higher the risk of a really bad, prolonged bear market wiping you out early on. For early retirees, modern financial planners now suggest a more conservative safe withdrawal rate, somewhere in the range of 3.25% to 3.5%. This lower rate builds in a bigger safety cushion, giving your portfolio a better chance of surviving for many decades. So, the best way to think about the 4% rule is as a compass, not a GPS. It's a fantastic tool to figure out how much you need to save for retirement. For example, if you want $40,000 a year, you know you need to aim for $1 million portfolio. It points you in the right direction. But when you actually retire and start withdrawing money, you need to be flexible. You have to pay attention to the market and be willing to adjust your plan if needed. The 4% rule is one of the most powerful concepts in personal finance. Understanding it gives you a clear target to aim for and a proven strategy for a secure retirement. Thanks for watching, and if you found this helpful, be sure to subscribe for more content that helps you master your money.